Okay, so we've actually began streaming. So we're streaming right now on Twitter, Facebook, LinkedIn, YouTube. And probably a minute or so, what I'll do is I'll let people in from the waiting room. We have 3 minutes, I think. Yeah. Now, what I've always wanted to do is connect my Instagram, but I don't know how to connect my Instagram to this live stream. So what I do is I do it separately on my phone. So I'm gonna set that live right now. Okay, so I'm live on Instagram. So I'm unable because I'm technologically challenged, right? I'm unable to connect my Instagram to the stream that I'm doing from Zoom. So this evening or morning, depending on where you are, I have we have probably about 100 or so people who are joining us for a webinar or live stream on U.S. Mexico tax. So okay, yeah. So US Mexico tax. And we're about to start in about 2 minutes. And again, forgive me if I'm looking in another direction. I'm looking at those that are on Zoom. But unfortunately, I can't connect Zoom to Instagram. That's my bad. So hey. So I'm gonna let people into the room. Let all. All right, so people are joining in, and what I'm gonna do is I'm gonna disable the waiting room feature so anyone can just come in and out as they see fit. And 1 more minute to go. All right. Okay, we're live. Welcome to the latest in our series of live streams on tax, that exciting topic. Thank you for joining us. This evening, we have Carlos Morales, who is going to join us for discussion on US Mexico tax issues. Please note that this is being live streamed and it is being recorded. So if you do not want your image to be captured, please switch off your camera. Otherwise, you will be recorded. And in the box below, you can type your questions. If you're on Zoom, if you're on Facebook or LinkedIn, similarly, you can type your questions down below and we will get them in the order in which you submit them. Thank you to those who submitted questions in advance. We got, I think, 10 or 11 questions in advance, which we will go through as well, but feel free to type your questions down below. So here's how we're going to do it. I'm just going to talk for not too long, probably like 10 minutes or so, just on the principles of US tax for those residing outside of the US. And then Carlos is going to say a few words and we just jump into the Q&A and just get right to it. So without further ado, I'm going to share my screen for a few slides. All right. Okay. All right. So as previously mentioned, my name is Darren Joseph, and I run a small international tax team within Moore's Rule in Asia Pacific. I'm actually based in Singapore, where we do international tax in general, but US international tax in particular. Our team is also a member of Fusion International. So that gives us access to expertise predominantly in Europe, but also in Mexico, which is how we have this great relationship with Carlos and his team as well. Because I am licensed by the US Department of Treasury, I'm legally required to say that everything that we discuss here this evening should not be construed as advice. I may be a tax professional, but I'm not your tax professional. Consider this an educational piece. Nothing that we say here should be construed as encouraging you to pay less than your fair share of taxes in any jurisdiction in which you are exposed. To get advice specific to your situation, you need to engage a tax professional who will get to know you inside out and can give advice specific to your situation. So this evening, we're having a general conversation, general principles. So, right, disclaimer in writing. So some of the quick takeaways, and I'll just jump into it. As you are aware, the US is one of many countries that practices worldwide taxation. So most developed countries, I dare say, so Europe, Japan, Australia, New Zealand, Canada, they all practice worldwide taxation. So once you are tax resident in their jurisdiction, you're subject to taxes on your worldwide income as you are in Mexico. What makes the US different is that it's really difficult to sever tax residency with the US. What it essentially requires is you to surrender your US passport or green card. With the other jurisdictions, once you leave and you check the box on certain things that you need to do, you can to some extent sever tax residency. With these other jurisdictions, with the US, you cannot. So just to cut to the chase, regardless of how long you reside in Mexico, you will be subject to you will be subject to US tax on your worldwide income. That will not change. So then people ask, well, hold on, I'm in Mexico, I'm outside of the US. How is the US government going to figure out what I'm up to? Come on. And the answer is this: FATCA, the Foreign Account Tax Compliance Act. So what does that mean? Basically, around 2010 or so, the U.S. passed certain laws in Congress, and it empowered the U.S. government to go around the world and sign bilateral agreements with countries all over the world, and countries that you think would not want to sign anything with the US, like China and Russia, they actually did sign. So I'd say most of the places that you'd want to go to, aside from, let's say, Cuba, North Korea, Iran, most countries would have signed this bilateral agreement with the US. And what did this agreement entail? These rules allowed countries like Mexico to set aside their domestic bank secrecy laws. I'm going to repeat that. They have set aside their domestic bank secrecy laws, and they look at every financial institution, looks through their accounts, looks through their account holders, and anyone that they suspect of being US exposed. They suspect. So even if because like many of us, we travel a lot, we have more than one passport. Maybe you can open an account with another passport, but even if you do, if that customer service person suspects that you are US exposed, and then a number of ways in which that suspicion can arise, which we don't probably need to get into. If they suspect that you are, they're legally required to report you to the US government. So that's a check and balance in the system, and that's basically how FATCA works. FATCA is not a tax; it's a framework for information exchange between countries like Mexico and the U.S. government. And there's something called the Common Reporting Standard, which we can get into if people ask questions about it. Now, here's really the takeaway. This is an acronym that I created that I thought was really helpful to US exposed persons who reside outside of the US. And what I tell them to do is basically do your best. And what do I mean by that? B, pay attention to your bank accounts. And when I say bank, by extension, I mean all financial accounts, maybe a brokerage account, an investment account, whatever. Every financial account you have outside of the US, once it passes certain thresholds, which we can get into, needs to be reported to Treasury. Every financial account that you have, once it passes certain thresholds, must be reported to Treasury. And this is not a new rule. This dates back to 1970, 1971 with the Bank Secrecy Act. So pay attention to your bank accounts. It doesn't normally figure in the calculation of any tax liability. It's simply a reporting requirement, because what you're going to soon figure out is that when it comes to international tax, the US government is less concerned with revenue collection than it is with data collection. Data is more important than money when it comes to international taxes. And that's for a number of reasons, which we can probably get into in the Q&A. So if you don't pay your taxes, okay, well, penalties and interest, right? But if you don't report bank accounts in Mexico or anywhere outside of the US, it could be up to 50% of the unreported balance. So I give people the example of a case where there was a dentist, I think a dentist in Florida. Many cases like this, was a typical one. He had $1 million in a bank account outside of the US, and he did not report it on his tax returns. And what was the penalty? The IRS held that he did not report that bank account for 3 years, and they went for the maximum. So 50% of the unreported balance. So in other words, they levied a penalty on him of $1.5 million in an account with $1 million in it. So again, once you have a bank account outside of the US, you're not going to be, there's no wealth tax or anything like that yet, where you'll be paying tax on the balance. So all you need to do is report the existence of the account. And of course, you report the interest or dividends or whatever. But please pay attention to your bank accounts. Next, estimated taxes. When you're in the US, typically you get paid on a W-2, and there will be withholding every fortnight, every month, or as the case may be. When you're outside and you're earning money, there's typically no opportunity for withholding and money to be sent to the IRS. And the IRS does not like to wait until the end of the year to get paid on earnings that you made during the year, right? So whoever you're working with, whichever tax team you decide to work with, or if you decide to do it yourself, of course, please make sure that you calculate what the estimated taxes would be. So in this case, it'll be for 2021. So you should have been calculating what your estimated taxes would be for 2021, and be prepared to make 4 quarterly payments to the IRS. Otherwise, you'll be hit with underpayment penalties and interest. So estimated taxes, please pay attention to it. Next, in terms of do your best, BES, S is in state tax issues. Some of you sent in questions, and this basically, you have 50 different states, 50 different rules. And for the most part, most states are domicile states. And what does that mean? It means that under certain circumstances, you may still be attached to those states, or even if you're not, and you have state source income, so you have rental property in whatever state you were last resident in. Be aware that you may have a state reporting and a tax filing requirement. And again, you need to speak with a tax professional who understands your situation, but pay attention to state tax issues. And again, people tell me, well, I'm in Mexico, I live outside of the US, who cares? What are they going to do? Fine me? Well, we've had so many clients, at some point in time, they return to the US and they return to their home state. And once the state figures out, the franchise tax board figures out that you're back, you get hit with a big penalty, plus, outstanding taxes. So they do wait for you, and states talk to the federal government. There's a communication line between the state and the IRS. So the states tend to be aware of what you have filed with the IRS and vice versa. So please bear that in mind. Last but not least, transfer taxes. Most people tend to be clued up on the fact that, hey, there are income taxes, but there are reporting requirements and sometimes taxes on transfers. And what I mean by transfers, I mean gifts. You living in Mexico, you may, for example, get into a relationship, personal or professional, with someone else in Mexico. And then you may invest, you may transfer, you may gift, or you may receive gifts, or whatever the case may be. Again, over certain thresholds, gifts made to or received from foreign nationals are reportable on tax returns. And the penalty could be up to 30% of the unreported gift So pay attention to that. And unfortunately, you know, it's a bit of a morbid topic, but estate taxes is something to talk about, especially right now when there's obviously a health crisis that we're going through. And this is something that people are becoming more and more painfully aware. So your estates need, you know, estate planning is highly recommended to prevent creating difficulties and challenges to your next of kin. If in the unlikely, an unfortunate event that something happens to you. So stepping back, big picture, do your best. BEST, bank accounts, estimated tax, state tax issues, and transfer taxes. So what I'm going to do is I'm going to stop there. And Carlos, please, Carlos will say a few words and then we just jump into the Q&A. Carlos, over to you. Carlos, you're on mute. You have to unmute yourself.
Hello, everyone. Thank you very much, Darren, for this invitation. And we'll be talking tonight about certain issues that has been questions for several people involved in Mexico and US taxation. At this time, I want to say that Mexico and the US have been neighbors and partners for a very long time. So the taxes that we have in Mexico has been as a consequence of the relationships and business within both countries. And even though we have our Mexican income tax law, we started with a Mexican-US treaty to avoid double taxation. Let's say 20 years ago. It was the first country with whom we start elaborating a lot of transactions in order to eliminate the double taxation. The Mexican income tax law, as Darren told us, also has a worldwide income source. So the Mexican IRS is always looking for everyone to be a Mexican resident. Our Mexican income tax law says that anyone having a permanent house living in Mexico is a Mexican resident for tax purposes. Also, if you have 50% or more of your income coming from a Mexican source, also you are considered as a national for tax purposes. And if your professional center of business is in Mexico, is another way to consider that you are a Mexican tax resident. So it's, let's say that a very aggressive way of treating everybody in the world, because everybody may be a Mexican resident for tax purposes. So we have another way to see their tax obligations through the Mexican-US treaty, with whom we have another kind of situations to consider if someone is Mexican resident. First of all, a permanent house of living. And if you have a house in Mexico and another in the US, then you might answer the question if you have personal or economic relationship. If you have in both countries, then you have to answer the question, where you're living, okay. And if you are living in both countries, then where you are national from, okay. So we have a lot of opportunities to be a non-Mexican tax resident if we rely upon the Mexican-US treaty. Another advantage of using the US treaty is that you are not crediting the taxes paid in the US. Let's say that if you are a Mexican resident, the taxes that are paid worldwide, you might consider them in your income tax return in Mexico. But if you look at the Mexico-US treaty, you don't have the obligation of filing a tax return in Mexico. There's a lot of advantages to look at the tax residence within the scope of this treaty. And another issue very important here is where are you taxing your income? So let's go through the questions. If you agree, Darren, to start going one by one and solving any other question specifically that may arise.
Yeah, thank you, Carlos. So what I'm going to do is go through the questions that were previously submitted. I see people writing questions right now. Please continue to do so. And once we go through the list and we get to yours, everything is going to be answered in turn. So the first one is just the preamble. Okay, I work for a company based in California, and we all work remotely, even before COVID-19, right? All my wages are deposited into my US bank account. I don't think I'm considered an expat. Question. I live in Mexico and recently gained temporary resident status. I don't earn any wages from a Mexican source. So US expat, living in Mexico, no Mexico source income, all US source income deposited into an account in the US. Carlos, what are your thoughts?
Okay. I think that the main situation to be analyzed here is that this person is living in Mexico. So living in Mexico, what implies? If this person is living in Mexico, let's say has a house in Mexico, then could be considered as a Mexican resident. If let's say that this person is working in Mexico but has a family outside in the US, or he has a passport in the US, so we can have a double taxation here. Maybe let's say the Mexican authority would look at the bank account in the US. It doesn't matter that it's outside Mexico. It doesn't matter that the company is based in California, but they would look at the residence of this person. It would be very important to this person to be clear of what is his Mexican status. I can say here that if this person is a Mexican resident by his permanent house living, then it would be very important to take him out of that situation. Maybe if he chooses to be a U.S. tax resident, maybe to file a suspension notice before the Mexican IRS in order to be out of the scope of the Mexican authorities, and also to file another notice at the mailbox of the Mexican IRS. It's very important to this person to look at his permanent house living to know if he has a risk or not.
Okay, understood. And from a US perspective, I mean, that's easy. They're definitely taxing their worldwide income. So they're going to have to pay tax on that. At the federal level, if it is, according to what you've described, if it is that they are exposed to taxes in Mexico, they can offset it against the US liability at the federal level with a Form 1116. But where they may fall in potentially to the double tax trap will be with California. California domicile state, very sticky. If they get paid on the W-2 and they are deemed to be domiciled in California, the state tax return may not because they typically do not recognize the fact that that income has been taxed somewhere else. They don't give tax credits for foreign taxes paid. So they'd probably want to revisit their tax status in California, as anybody else who's in one of those states. We always advise our clients before they leave the US, pick one of the 9 states that does not have an income tax. Popularly, it'll be Texas, Florida, uh, Tennessee, Nevada, whichever you prefer. Pick one of those and establish domicile there. How do you do that? Again, you need to speak with a tax advisor, because it's not really a hard and fast rule. It's a test of facts and circumstances. So you'd want to, for example, make sure you're registered to vote in that state. You hold mail, you have some sort of address, mailing address in that state. Your driver's license switches to that state, and so on. So you want to shift your domicile to prevent issues with states like California, especially since California has been contemplating a wealth tax. So again, you just want to be careful with states like that. Okay, moving on to question 2. I have a vacation home in Mexico. I do not stay more than 6 months in the year in Mexico. But when I'm not in Mexico, I leave my home unoccupied. I don't use Airbnb. Am I tax resident in Mexico? Carlos.
Well, the question here is that this will assume that this person has his income outside Mexican source. They has no family in Mexico. All the whole life of this person is in the U.S. And we have regulations here in Mexico that says that when you have a home in Mexico, which is not a permanent one, which is only a vacation home, you are not a Mexican tax resident.
Right. Mm-hmm. Okay, so I'll allow me to follow up on that just so that I'm clear. So what's the definition of a vacation home?
Vacation home is the one that you have for vacation, not the one you have for living. When you have also your family, or even you can be working alone in Mexico, but it's related to the income that is generated. So let's look at it. Even if this person have a vacation home rented by Airbnb, let's say, that's not a situation that is considered as a permanent house living, and it's not a Mexican tax resident.
Understood. Okay, fantastic. Thank you for that, Carlos. Next question. I run my Belize company from Mexico. Everything is being banked outside of Mexico. Where should I file my taxes? Carlos.
This is a very interesting question. Very huge one. Okay, let's start from the beginning. I think that this person has a company. So he is a shareholder of a Belize company. Okay. With Belize, Mexico has a treaty to exchange information. So we have to be very clear about that. We have this treaty from November 2011. So as Belize is considered as, let's say, a low tax jurisdiction, so we have to be very wise to know if this shareholder has control over the income of this company. Why? Because maybe this person has a Belize company and takes the administration decisions, earns the dividends of that company, and in Belize is not paying taxes. So the Mexican IRS will be here very aggressive, trying to tax all the indirect income coming from that jurisdiction. And the main point here is, if this person, even he's running the company here in Mexico, if he's a tax resident, Maybe if we look at all the situations that are in the Mexico-US treaty, maybe we can take him out of the tax resident situation. That will be very interesting to know. And so if he's a Mexican tax resident, my recommendation is to look it through the Mexico-US treaty in order to know if he's or not with the obligation of paying taxes here.
Understood. And then from a US perspective, assuming when he says that, or he or she says that I'm running the company, if they are the key decision maker, they're the ones making the strategic, the operational decisions, plus they are the majority shareholder, it definitely reportable on their US tax returns, Form 5471. Any investment they make into the company must also be reported in their personal tax returns, Form 926. Now, if it is a CFC or control foreign corp, as it appears to be, certain rules would apply. We'd want to sit with this person and see whether subpart F rules would apply. If it's being taxed only in Belize, something called GILTI, the Global Intangible Low Tax Income Tax rules may apply. So there are a number of, when you have a US controlled foreign company, this control foreign corp or the CFC rules work very aggressively to basically make it very difficult to defer paying income until there's a distribution, which is of course the holy grail. People want to earn money and let it work in the company and only pay when there's a distribution. It works against that. And plus it puts an additional layer of taxes if you're in a low tax jurisdiction like Belize, because essentially what it does, it taxes phantom income because you did not receive their income. You have not constructively received it. There was no dividends. You didn't get a bonus or whatever. It's still sitting on the balance sheet. But GILTI works to put a tax on it, even though it was not distributed to you as a shareholder. And that, of course, has cash flow implications because you're going to need to pay tax on money that you did not receive. So because of situations like that, I think it's worthwhile sitting with a tax professional to make sure that it's the right structure for you. And let's look at ways, as Carlos said, and together with someone with Carlos's expertise to make sure that you minimize the tax burden on that. Okay.
Yes, and I think that Mexico copied that tax regime for low jurisdiction countries. It's the same as you told us. So the point here is that somehow these men or women should be very sure of where is he a tax resident, because maybe the amount of taxes will be almost the same. But this is a very interesting question.
Interesting indeed. Okay, next question. Okay, how do I avoid becoming tax resident in Mexico?
Well, this is very, very, very interesting and very complicated also, because to be sure that you won't be a Mexican tax resident, the advice here is to have all the documents required to demonstrate that you are resident in another country. Okay, not to leave it open to the Mexican authorities to assume that you are a Mexican tax resident. So the suggestion here maybe is, if this person might be interested in being a US tax resident, maybe he can call this tax resident certificate, which is, I'm not an expert, maybe you can help me, but there's a form 8802 that brings you a tax resident certificate named 6166. This person can request that annually, and with that documents and the documents demonstrating where he living, where's his relationships or her economic sources, everything will be a part of his files to demonstrate that he or she is not a Mexican tax resident.
Yeah, that's, I completely agree with that, Carlos. So, and again, we're discussing here a situation where we can rely on the treaty. We can take a treaty position, and we claim a closer connection, in this case, presumably to the US. So there's a closer connection to the US. Probably they still have a place of residence available for them. They have an unrented, available, empty home for them back in the US. They still maintain family ties. Important family members are still there, so on and so forth. So in a situation like that, you're right, they can get their residence certificate and be free of the Mexico tax net. However, I'm just a bit of a disclaimer here. We've had clients that come to us, and when we look at the facts and circumstances, they are clearly resident, in this case in Mexico. That is their base, and then they make claims like, well, I can use my sister's address back in the US, the resident certificate. I know that other tax professionals may encourage that, but we certainly don't. We follow the law. But definitely, if it is that you meet the criteria set out in the treaty, we will definitely help you optimize your tax position between Mexico and the US, if that would mean claiming that closer connection to the US, but nothing underhanded, please.
Yes, and everyone is a different story. So
Everybody,
we have to be very sure to have everything with documents. We
absolutely.
have to demonstrate before Mexican authorities everything with papers, with documents, because the charge of the proof is on the taxpayer, not on the authority.
All right, moving on to the next one, because I see more questions popping up as we go through these. Do I declare my bank accounts in Mexico on my US returns? Yes, there's a form called a FinCEN 114, otherwise known as FBARS, Foreign Bank Account Report. Again, this is not new. This comes from the Bank Secrecy Act. I think I mentioned it in one of the slides. Once it's above a certain threshold, it needs to be reported on those forms. That's the FBAR threshold. There's also an additional threshold that came in when FATCA came in. It's called a Form 8938. Again, if you have there's some higher thresholds that apply, and you can speak to your professional about that, your chosen tax professional. It may be reportable in 8938, which is attached to your personal tax returns. So definitely, yes.
And of course, Mexico and the US has a broad information exchange treaty. So even though if a person in the US or in Mexico try to hide their bank accounts, sooner or later, the authorities will have notice of this.
Absolutely. Absolutely. Okay. Next question. I have not filed US returns for the past 4 years. Only Mexico returns. What should I do? So, okay, so you're complying with Mexico. That's fine. On the US side, when you sit with your US tax professional, we need to understand what was the reason for this non-compliance for the past 4 years. If it is, we invoke and we need to discuss a legal concept called willfulness. And willfulness is not defined in the tax code. We need to rely on case law. And what case law tells us is that they look at basically whether it's a known violation of this legal responsibility, whether you intentionally sought to avoid this responsibility. And how do you evidence that intent? Whether it's clear that you have knowledge of it, and what type of action did you take? Did you use nominees? Did you look at accounts in certain secret jurisdictions? Did you tell the financial institution to hold the mail so that the mail wouldn't go back to your address? Things like that. So if it is, but let's fast forward and let's assume that your non-compliance was non-willful. Life just got the better of you. You're in Mexico and you're trying to make things work, and maybe you forgot, or maybe your circumstances, you had personal difficulties or whatever. Then there's something called the streamlined compliance procedure. Streamlined is an amnesty in all but name. The look back period is 3 years. So the last 3 years for which the due date has already passed, which in this case will be 2019, 18, 17. We get those returns filed, and assuming that everything goes okay, well, you don't have to pay, you don't have to worry about penalties. And this is civil and criminal penalties, which would typically apply. You would pay taxes if any taxes are due, plus interest, but more importantly, you avoid those penalties. That's really important. So, and even if you did not file for longer than 4 or 5 years, it doesn't matter. The look back period, because of the statute of limitations, is just 3 years. So we work with you on that, and it's 6 years for FBARs. We go back as long as 6 years, again, driven by the statute of limitation. So we work with clients through that process to get on the right side of the IRS. And of course, they agree to do the right thing going forward. So the point I want to make is, don't stress out. Don't think you're gonna, the world is gonna end or whatever. The important thing is that you recognize, hey, I should have filed, and I'm gonna make things right now. I'm gonna make things right. So you sit with your chosen professional and you get that streamlined package in as soon as possible, and then you can breathe this out. So,
And for the Mexican standpoint of view, if this person file his returns in Mexico, we hope that he accrued the income worldwide basis.
yeah,
So if we are in that situation, it's okay. If not, if he lacks of declaring income from other sources, maybe he has to start also to file complementary tax returns of the 5 previous years. Here in Mexico, there we have to be aware of 5 years in this statute of limitations.
gotcha. Perfect. Okay, and this is a really popular one now. How is crypto taxed both in Mexico and the US? Carlos, crypto in Mexico.
Well, this is a very, very new situation. It's not foreseen as a specific kind of income in Mexico, but here individuals are obligated to accrue their income, even if it is in cash, in goods, in credits, or what other kind of income. So let's assume that this kind of crypto is an income, whatever it be. So in general terms, this person having income from this kind of transactions should be paying taxes in Mexico, without regarding if this is a foreign company or Mexican company or wherever the source of income comes from.
Understood. And from a US perspective, it's I think it's also straightforward to the extent that, yeah, you're gonna have to pay taxes on it. Right now, I think it was last year, they redesigned the main tax form for personal tax returns, is Form 1040, and the first questions on page 1 is, do you trade in crypto? So it's definitely a priority of the US government. In terms of how it's actually taxed, unfortunately, it depends. If it is that you do it on the side and you're kind of a buy and hold kind of person, then whenever you do sell it, you'll be looking at capital gains tax. If you sell within a 12-month period, it'll be short-term capital gains. If it's longer than 12 months, it's long-term capital gains. If it is, we have clients that it's not something they do on the side, they actually trade. So they do several transactions per day. It is their main thing. We have clients that do hundreds of transactions per day, algorithmic trading. Then that is a business, and that's not capital gains. That's trading income. That's and you would tend to do that through a company. So you're looking at corporate tax issues that you need to look at. We have people that do mining, crypto lending. If you're lending, you get interest. Obviously, you're gonna declare the interest on Schedule B. So it really depends. But the bottom line is that it's all taxable. And the important thing is to keep track of all the trades, which I know can be very difficult. There's software tools that help you do it, depending on which platforms you use, whether it's Coinbase or Kraken or whatever. There are options to print reports. You try to get those as accurately as possible. In terms of valuing the transactions, it can't be random. You need to decide whether you're going to use LIFO, FIFO, HIFO, whether it's last in, first out, which is not that popular, but some people do use it. Most people would use first in, first out. You need to track each token, each item. You need to track when you sell it, when did you buy that, and that transaction. Also, please bear in mind that crypto to crypto can also be taxable. Some people think it's just crypto to fiat. Crypto to crypto can also be taxable. So again, sit with your tax professional and get solid advice. Next one. What happens if I don't report my offshore business to the IRS? Yeah. I guess that kind of ties back into the previous question on Streamline. And this reminds me, I had a client that actually had a situation like that recently, where he was dealing with another tax team who was based in the US. So obviously, if you're based in the US, you tend to know domestic tax because that's what you do day in, day out, not international tax. And his domestic tax team was unaware that there was a responsibility to report companies outside of the US. Just didn't know, because you don't do that every day. We do, right? So I informed him of this responsibility and the fact that perhaps he needs to consider Streamline, like we just discussed. And he got really upset because, he found out that the penalty for not reporting a company that you have an interest in and should be on your tax return could be up, could be $10,000 per year. And the company's been running for a few years. So, he was screaming on the phone and stuff like that. But the point is that it doesn't mean the world is coming to an end. Sit with your chosen tax professional. You can potentially get on Streamline if Streamline fits your circumstances, and you can backfile those returns and make things right with the IRS. So.
And from the Mexican IRS, the situation is very similar, but as well, we have the obligation to file that someone has offshore business. But even if you do not declare those investments, it is considered as a criminal act. So it's very important to be aware of this.
Mm-hmm. Absolutely. There's another question on foreign rental property. So, of course, if it is that you have property in Mexico and you have investment properties, not like the previous questioner who has it for their own personal use. If it's an investment property and you derive income from it, whether it's through Airbnb or a long-term lease or rental arrangement, it needs to be declared on your personal tax returns. Now, so that goes without question. Now, you have to declare that income, but just like if it were a rental property back in the US, you get to deduct the expenses. And one of the key expense line items, just like it is in the US, is depreciation. Now, the question is, how long is the number of years that the depreciation basis? If it is, the person didn't specify, I'll assume it's a residential rental property. If it's residential, it can be depreciated over 30 years. If it's non-residential, it's over 40 years. So I hope that answers that person's question. They're asking about depreciating an investment property in Mexico. They did not specify, the person who sent in this question, you did not specify whether it was residential or non-residential. So I'm going to give you both. If it's residential, it's over 30 years. If it's non-residential, i.e. commercial, for example, it'll be over 40 years. Carlos, any comments on that?
Yes, this is a very interesting situation because when a foreign resident has an investment, a real estate investment in Mexico, then when this person sells the property, they have to pay 25% over the whole price of the real estate property. It's a lot of money, but we have an option. The second option here is very interesting, because if you are the owner of the property and you assign a Mexican representative, then this person could make the calculation of the right tax over the profit gain. So you have the price less the cost of this purchase, and over the gain, only over the gain, you may calculate the income tax. So it's a very interesting option to consider.
Okay. Sorry, the first point you made, that 25%, that's 25% of the gross price, the selling price, or net?
Yes, or the whole price.
Wow. Yeah,
that's a lot of money.
That is aggressive. But the US has an equivalent called FIRPTA, the Foreign Investor Real Property Tax Act. So where, I guess because they're afraid that foreign investors aren't going to file tax returns, they take a big chunk of the headline price of the gross selling price. So it mirrors the US situation, which is interesting. Yeah. Okay. Next question. If a US citizen who qualifies for the foreign earned income exclusion as a bona fide resident by the IRS, so okay, the US citizen qualifies for the foreign earned income exclusion under the bona fide residence test, will he or she, one, need to file tax returns, and two, pay taxes for the state of Colorado? Very, very specific. So I'll answer it from the US side first. So Section 911, the foreign earning income exclusion, which is perhaps the best tax benefit available to the average US expat. So, right, I think with 2020, it's 108,000 roughly dollars would be excluded, plus your housing deduction. But the point to drive home, and it's a common misconception, so I'm glad this person asked it, even though your earnings are below the foreign earned income exclusion, it still needs to be reported. You're still going to file a tax return, even to the US, even though no taxes are going to be due. A tax return still needs to be filed. So whether you qualify on the bona fide resident or the physical presence test, either. So even though you don't have to pay taxes because it's under the threshold, a tax return is still due. Now, as to the second part of the question, to the state of Colorado, like California, Colorado is a domicile state. So again, so typically, if you have established bona fide residence somewhere else, for example, in Mexico, it can relieve you, under certain circumstances, can relieve you of the obligation to file a resident tax return to Colorado. And in that scenario, you'll just be filing a non-resident tax return based on state source income. But regardless, my same comment to the person from California, I would apply to this situation. You should pick one of the 9 states in which there is no income tax and re-domicile there, so that there's no confusion with Colorado. So that's my comment on that. Carlos?
I have no comments here, because Mexico does not consider to get a tax residence for a specific state. So maybe for Mexican tax purposes, we need only a federal tax residence certificate.
Okay, understood. Okay. Next question. It's a long question, so I'll try and summarize it rather than read everything. So this US citizen is married to a Mexican national, and they're living in Mexico and getting confirmed. Okay, so I guess they want to file together, which is a tax strategy that we do recommend for some of our clients. Even though your spouse is not a US person for tax purposes under Section 7701, you can elect for them to be a US person, and you can file together under Section 6013G. And it could be a good strategy for a couple in a specific situation. Her question, however, is the process for applying for tax ID for her husband, her Mexican husband. She's having problems dealing with CPA firms and the ITIN, which is the individual tax identification number. Now, typically, if someone does not qualify for a social security number, by virtue of them not being a US person for tax purposes. So they are not a citizen, they're not a green card holder, they don't trigger substantial presence, then they would typically need to file for an individual tax identification number, otherwise known as an ITIN. And that's the principle. In practice, it can be very challenging because in her case, the firm that she's approached, I think in Mexico City, to do it, they don't just want to apply for the ITIN for her. They want to do the tax returns at the same time. Now, this happens more often than you may think. The reason is it's really tricky to do the ITIN application on its own without doing the tax return together. If the ideal is for them to be done at the same time by the same team, otherwise, it leads to complications. I can get into the details, but perhaps it's not necessary. I'll just leave it there. It can lead to complexity, and it can lead to misunderstanding between the team that's doing the return and the team that's doing the ITIN application. So that's why it tends to be done under the same roof. Our team, we're certified acceptance agents as well. So we do ITIN applications. And I am very hesitant to do an ITIN application when we're not doing the tax return because of that complexity. So my point to this person who wrote that question is that it's not unusual, but if they don't want whoever they've approached to do their tax return, they want to keep that separate, just look at the IRS website, and there are probably hundreds, if not thousands, of firms that do it, and just pick another firm until you find one that can work with you. Otherwise, you have to do it yourself, which would mean surrendering his passport. And I would not advise that because processing times with the Internal Revenue Service are really, really long right now because of social distancing and stuff within the IRS offices. So use a certified acceptance agent where possible, but be prepared for difficulties if you don't want to give them the entire job to do. So sorry, that's probably not what you want to hear, but that's the reality. Moving on to another list of questions. I know we almost at the hour mark. We have about 10 minutes to go. Someone has asked, if you're the owner of a company, or I guess a partnership, or a partner in a partnership, sorry, I'm not seeing the full question. Mr. Glavinik, Tony Glavinik. Could you, I think your question got cut in parts, so could you type it out again, please? I'll wait for you. Next one. What classifies you as a tax-paying resident in Mexico? Carlos?
Okay, a taxpayer in Mexico, let's say that we have two ways to see it. The first one is within our Mexican income tax law. We also mentioned that. If a person has permanent house living in Mexico. The other situation, if this person has more than 50% of the income coming from a Mexican source, it's the second situation. And the third one is if his professional center is located in Mexico. Even though if you are a national, if you born in Mexico, if you have a Mexican passport, then it's assumed that you are a Mexican resident. That's the assumptions that the Mexican law has. So we prefer to use the U.S.-Mexico treaty because we have much more wider situations to be analyzed in order to see if someone is or is not a Mexican tax resident.
Yeah. Right. There's a lot of facts that we would need to analyze to make that determination. Gotcha.
Yes, within the treaty we have a permanent house living is one. Second one is have personal and economic relationships without regarding a percentage of income source in Mexico. Where is living the person, if he's national or not. And with that, we have a lot of information and documents that we have to file in order to direct everything right as we want.
Understood. And following up from that point, I guess, is when you say a permanent house, does it mean a house that you have purchased and you own it? Or what about if you're renting that house?
Well, this is not as clear. So it is in order to see if someone has a house owned or rented in Mexico, and you have another one owned or rented in the US, so you are even. You don't know at this point if you are Mexican or you are resident. You have to go further on the next questions, to define where is resident is this person.
So in other words, the home is one fact, but it's not the only fact. So one would need to look at the wider picture to make that determination.
Yeah, that's right.
Okay. Next question. Wife and I are U.S. military vets. Thank you for your service. Receiving VA paid benefits going into our U.S. bank account. I have dual citizenship and my wife is a permanent resident of Mexico. So one, the husband, dual citizen, US, Mexico, wife, a permanent resident of Mexico. We're living in Mexico, renting. Will Mexico touch VA payments, the veterans military pay? Question.
Okay. The question. Well, I understand that this man is receiving wages from the U.S. military service. Is that right?
He's retired, but he's dual. He's retired, living in Mexico with his wife.
Okay, and the source of income is coming from a U.S. source.
Correct, and it's being paid in the U.S., not in Mexico, but in the U.S. Yeah,
it's paid in the U.S. Okay, so in that situation, I think that they are a Mexican resident because they are living there. They have a family. They have their interest of living there, so they are a Mexican tax resident. I don't know if in this case the military service is withholding some income tax in the U.S. In that case, this person in Mexico could credit the amount paid in the U.S. That would be very useful in order to have his annual tax return in Mexico.
Right. Okay. So potentially, yes, once assuming the center of life is in Mexico, which it appears it is, but they will get a credit potentially for taxes paid in the US already on that income when they're filing the Mexico tax returns potentially, right?
Yes, and also in Mexico we have the option to consider that amount in one annual return or two annual returns, one of for each one of the wife and the husband.
Right, like in the US, you can file married filing jointly or married filing separately. So I hear that. So he goes on to ask another question. He would like to start a small business in Mexico. The question is, would both the US and Mexico tax my business? Carlos?
Okay, if they want to start a business in Mexico, we have several options. You can start a business like an individual, which has benefits because of the tax rate. You can start with a 3% income tax rate up to 35%. It's an advantage because if you start a business having a company, there's a flat 3% income tax rate. So for start a business, my recommendation is to start as an individual. And if it starts growing and growing, then you can set up a company.
Right. And that's similar to the US as well, in that you can start the business as a sole proprietor. So on the US return, I'll be on your Schedule C. Or you can incorporate a company and the company trades and the company files its own returns. And you as a person pay tax only when you get a distribution from the company in form of dividends or salary or something like that. So I think in a situation like this, perhaps they'd want to sit with a tax professional like you, especially on the Mexico side, to see what makes the most sense for them, what's optimal from a tax point of view, given that the disparity in terms of tax rates are so high. That's a big difference between 3 and 30%, right? So
a lot of money. And also they can set up a company as a foreign residents.
Yeah.
A few years ago, they were only allowed to set up company Mexican partners. So with two people, if they are U.S. resident, they can do it without losing their tax status.
Mhm.
They can file everything within their Mexican company, and they can comply with their personal obligations in the U.S.
Okay, wonderful. Next question. Is it possible to qualify as bona fide residents under the U.S. foreign earned income exclusion by living in Mexico without being tax resident in Mexico? The answer is yes, because you can qualify for the Section 911 foreign earned income exclusion in two ways. One is the bona fide residence test, which is it's qualitative and it's a test. It's a bit subjective in that, on Form 2555, the IRS asks you certain questions to determine whether your center of life really has shifted to that foreign jurisdiction. It's a judgment call. The other way of qualifying for the foreign earned income exclusion is the physical presence test, which, unlike the bona fide residence test, it is subjective and it's quantitative. So basically, you count in a number of days in the US. And once you don't cross that number, once you don't spend more than, let's say, 30 days in the US, and you spend the rest outside, including Mexico, you could be Mexico plus Panama, plus Chile, plus wherever else. Once you stay out of the US, you can trigger and you can enjoy the protection of the foreign earned income exclusion. So to answer your question, yes, you can qualify. Look at the physical presence test when you're doing Form 2555. Next question. Okay, it's a statement plus a question. Okay, it sounds like I'm a Mexican tax resident then. I'm married to a Mexican national and have temporary residency. My US tax return is, okay, this is the person with the W-7, okay, who wants to get a tax ID for their Mexican national husband. What do I need to do to keep Mexico happy too? I do not have any Mexican accounts or property, and all my income is moving through US bank account. So this is one for you, Carlos. I'll start over. So this is a US national resident in Mexico, married to a Mexican national, and she has her temporary residency. And they seem to have resolved the issue with the US tax returns and the tax ID stuff. So she's asking, what do I need to do to keep Mexico happy too? I do not have any Mexican accounts or property, and all my income is moving through US bank accounts. Carlos?
Let me see. As a foreign resident, sometimes it's difficult to start a bank account here. Maybe if let's say if the husband is a Mexican tax resident, maybe he can open a bank account and have, let's say, allow the wife to sign and have all the rights of that bank account. In that case, she can operate everything through that bank account.
Okay, understand. And from a tax perspective, I mean, the center of life is Mexico, so she's going to be taxed on her worldwide income. Yeah,
Well, she
potential.
could be potentially, but also she has the option to file the annual return jointly with his husband
Right.
without having a Mexican IRS and a Mexican tax ID. Excuse me.
Uh,
Other option, if they are, let's say, having different income, no, let's say that she's working in a company and he's working in another one. So in that case, she might be requesting a Mexican tax ID.
right. So the choice is whether she files alone or jointly with her husband. And again, sitting with a tax professional like yourself might be the best way to make that sort of determination. Okay.
Yes.
All right. Moving down. This is okay. The military question again. Oh, someone just made a comment. Mexican billionaire Ricardo Salinas is big into crypto. I'm sure that's agreed on Mexico. Yeah. All right. Next question. What is the difference in capital gains of real estate for US expats via fideicomiso versus a Mexican national? For example, if you buy a house for 100K and sell it for 200K years later, what are the tax rates for each from a Mexico perspective, Carlos? You get that? Yeah.
Yeah. Yeah. In terms, it's similar to a previous question. If they are selling in 200 and the cost was 100,
Yeah.
the first option is that they must pay 25% over the 200. So
Yeah.
over the wholesale price. It's a lot of money. And the other situation, the other option that you have is that this person could assign a representative in Mexico, and that person must calculate over the difference between the 200 and 100, which is the cost. So they will be paying 35% over the profit.
Right. So just to clarify that, so there are two options. If they were to just kind of keep it and try and do it themselves, then the Mexican tax authority is going to take 25% of the gross, so that 200K,
Gross.
they're going to grab 25% of that, which is of course huge. If it is that they get a Mexican national to
Representative.
more or less take responsibility for the situation, then it will be taxed on the difference between the 200 selling price and the 100, and it'll be taxed at whatever the tax rate is, depending on how much it is, right? Or is it
That's
a
right. That's right. And in this example, we might say that it's they will pay much more on the second option. They will be paying 35, and with the first one, 25. So they have to see the specific situation in order to elect, to choose which one of the options is better.
understood?
And every one of the transactions regarding real estate should be before a public notary. So it's very important to choose before going with the public notary, because they are in charge of looking of the compliance of taxes.
Fantastic. And with that, we're going to have to say thank you. Thank you, Carlos, for sharing your expertise and your time this evening. And thanks for all of those who joined us here on Zoom, as well as on Facebook, LinkedIn, Twitter, and on YouTube. This everything will be recorded, and so if you want to watch this video again, it'll be on the various platforms, and we also put it on podcast platforms as well. So wherever you get your favorite podcast, you can get it. If you want to reach out to Carlos specifically to follow up and engage him and his team, his email address is in the chat box below on Zoom. So it's Carlos AMG tat@gmail.com. I'm going to repeat it. carlos.amg.bstat@gmail.com. That's Carlos. And we're Tax. Thank you for joining us, and we'll see you next time. Bye-bye.
Thank you, everyone.